In business, revenues minus costs give you profit. In personal financial planning, earnings minus expenses are what determine your wealth. While increasing earnings is good, and one of the reasons to go to college is to increase your earnings, the primary focus in generating wealth needs to be on controlling expenses. There are plenty of doctors and lawyers who are actually living paycheck to paycheck. It's part of human nature that people tend to be able to spend however much money they have. The only way to generate wealth is to manage and control your expenses to be able to spend less than you make. When looking at expenses, it's important to focus on those things that we can control. From Chapter 24, Table 24.1 presents expenses as fixed and controllable. And the fixed expenses column, number 1 is paying yourself or savings. Saving money for emergency, saving money for retirements, for college education, for your children is an important expense, and it should be considered a fixed and required expense. A number of the other expenses, while listed under fixed, are in the long run variable. Rent, for example, depends on where you choose to live. You can reduce your rent by finding a smaller apartment, finding it farther out of town, and reducing your expenses. Similarly, on utilities, being more efficient, turning off lights can reduce your expenses. Some expenses, though, are truly fixed. Minimum credit card payments, minimum student loan payments are required in fixed expenses. So in managing expenses, it's the controllable expenses that really require the focus, that really require the monitoring and control and planning. Reducing expenses means to focus on everything, every small detail. Many small holes will sink a ship, and small expenses add up to large expenses. As an example, suppose you have a habit of going to Starbucks every day and buying a venti cup of coffee at $2.45. It doesn't seem like much, and some people buy their caramel macchiato at even more than $2.45 a cup, or may go more than once a day. Well, let's keep this example simple. $2.45 a day. Another option is to go to Costco, buy ground coffee, make coffee at home, and bring it with you in a thermos. Let's look at the difference in cost of these two options. With a little research on the internet, you can find there are between 75 and 80 tablespoons of coffee per pound. And you can find that it takes about 2 tablespoons of coffee for an 8-ounce cup. Trip to Costco, you can find that 3 pounds of coffee, Costco brand, go for $8.59. With that information, you can calculate how much you're spending for the equivalent of a venti cup of coffee. We're going to start off with 2 tablespoons per 8-ounce cup of coffee. What we want to get is the cost for a venti cup, which means we have to do a little units conversion. The key thing to units conversion, we want to multiply by ratios that are equivalent quantities but change the units of measure. For example, 1 pound of coffee is 75 tablespoons. 1 can from Costco is 3 pounds. $8.59 will buy you a can of coffee from Costco. And a venti cup of coffee is 20 ounces. All these are equal. And what we're going to do is arrange them so that we can cancel out the units of measure. We want to get rid of the tablespoons, so we're going to have the 75 tablespoons in the denominator to cancel the 75 in the numerator. Similarly, we want to get rid of the pounds, so we have 3 pounds in the denominator, 1 can in the numerator. We want to convert from cans to dollars, so the cans cancel out. And finally, we want to get rid of the ounces. So what we're left with is dollars per venti cup. Doing the units conversion this way helps us to keep from making mistakes. We realize we need to divide by 75, divide by 3, multiply by 8.59, and multiply by 20 to get a final cost of 20 cents per venti cup of coffee if you make it yourself using Costco coffee. Now that we know we can make a cup of Costco coffee for 20 cents per venti-sized cup, we can figure out what we're spending per year Starbucks compared to Costco. Starbucks, for 1 year, 5 days per week, buying 1 cup of coffee every working day, it's $2.45 per cup, 5 cups over a week, This allows us to cancel out the cup. 52 weeks in 1 year allows us to cancel out the weeks, and we'll be spending $637 per year. That $2.45 starts to add up if we look at how many times a week we do that and how many weeks a year there are. That $2.45 cup of coffee adds up when we look at how many times a year we spend that money. Small holes can sink big ships. Using Costco coffee, on the other hand, we have 20 cents per cup, 5 cups per week, 52 weeks a year. We're only spending $52 per year. So in 1 year, we'll save $585. That's a significant sum of money, but we need to go one step further. If we're going to do this over our working career, let's say 30 years, we can invest our annual savings of $585. Suppose we can do that at 8% interest. From chapter 14 in the textbook, we're going to have a series of payments. In this example, instead of 100, it's going to be 585. Every year for 30 years, if we invest that at 8% interest, how much money do we get to have at the end of 30 years? The future value formula in Excel will allow us to do that. We have to specify the interest rate, how many years we'll be investing at, and we put in the negative value for what we're spending every year. So at 8%, it's 0.08 over 30 years. Saving or investing that $585 gives us a total of $71,572. Now, in 30 years, inflation may reduce the value of that money, but that's still a significant amount of money from simply making coffee at home versus buying it from Starbucks. So this is what has to happen if you want to manage your expenses, is look at everything that's leaving your pocket, that's leaving your wallet, and say, is that really worth what it's costing me? What is it costing me over the long run? And what are alternatives? If you take care of your pennies, the dollars will take care of themselves. The way to control expenses is through a budgeting process. First step is to develop a budget. What do you spend every month? What do you bring in every month? And you have to bring in more than you spend. But that's only the first step. You need to track income and spending. When you first develop a budget, you probably won't include everything that you're spending money on. There's a lot of cases where we spend money and we don't realize that we're spending money. So the important thing is to track this spending and then compare the budget with our actual spending and our actual income. There's very likely to be a difference, and it's very likely that we're going to spend more than we planned for in our budget. From that, we need to revise the budget and adjust our spending. In some cases, there may be something we need to spend money on that we have to spend that we didn't realize and didn't include. Frequently, we need to adjust our spending. Then we go back to track our income and spending, and this is a cycle that repeats. We're always going to compare our budget to actual and adjust and revise our spending. Not just for monitoring spending purposes, but also as time goes on, we're going to have different priorities. Our income is going to change. We're going to have different expenses. We're going to have different goals in our budgeting process. So budgeting is an ongoing process of planning, executing, evaluating, and adjusting. We have to set goals when we're budgeting. For example, the first thing someone should do is, if they don't have an emergency fund, very quickly save to have at least $1,000 in an emergency fund. The 2020 coronavirus pandemic has certainly highlighted the need to have emergency funds. That pandemic has highlighted how many people live paycheck to paycheck, and when that paycheck gets disrupted, they're in serious financial straits. So the first goal for anybody's budget is to establish a basic emergency fund if you don't already have one. If a company has a 401k plan, frequently the company will match a contribution up to 5% or more. And if you're not taking advantage of that immediate doubling of your money, plus the tax savings in investing in retirement, that's the next step as a goal. Next, pay off credit cards. As we'll see a little bit later, and maintaining a credit card balance is a very expensive luxury that you really can't afford. Next, that $1,000 emergency fund should expand into a 6-month survival emergency fund. What you need to do is look at, what do I really have to spend money on, taking out the luxuries, So if I'm in a situation like the coronavirus pandemic and I lose my job, I can go at least 6 months without incurring any debt. Next, your goal should be to invest at least 10% in your 401k plan. If your employer matches that with 5%, you're well on your way to a good retirement plan. A next goal might be to pay off your student loans. Finally, saving for a house, saving for children's education. The important thing in financial planning is to set goals and to prioritize those goals. The concept of SMART goals has been presented a number of places in this textbook. SMART goals are specific. In the case of financial planning, you want to specify exactly what you're going to do each month. For example, contributing $400 to your 401k plan every month. Should be measurable. Create an emergency fund, but instead of just defining it as a 6-month emergency fund, determine the actual dollar amount that you need to save. Assignable. It's really only you as an individual or as a couple that can take care of financial planning. Personal finances are frequently a major issue in problems with married couples. Realistic. Your budget should have some fun money, especially if you're living as a couple. Each person should have a certain amount of money every month that they can spend however they choose. If your budget is too draconian, you really can't live with it and you can't stick with it. Just like having a diet that's too restrictive or draconian. If you don't have a few things that are fun in your diet or fun in your life or fun in your financial planning, it's hard to stick with it. So shouldn't be unreasonable, but there should be some fun money to make for a realistic budget. And finally, time related. Not only setting the goal of creating the emergency fund, but how long are you going to take to achieve that particular goal? Investing for retirement is important and something that should be done as soon as you've established a career. Many people think that that's something that you can do later on, but in fact, you're going to be much more successful if you start early, even if you're starting relatively small. First, you should use a 401k or traditional IRA or Roth IRA to avoid taxes. This gives you immediate return on your investment. 401ks and traditional IRAs allow you to put in money pre-tax. With a Roth IRA, you invest after tax dollars. However, when you take money out of the Roth IRA, you can avoid income taxes on the money you've earned on those savings. So once you've maximized a 401k and or traditional IRA, a Roth IRA is a good way to save money. Second, take advantage of a company match. Companies will frequently match 90 to 100% of an investment up to a certain percentage of your income. Again, that's an immediate return on investment that you can't pass up. Finally, start now. Start as soon as possible. If you start now, you'll take advantage of the miracle of compound interest. What is the miracle of compound interest? Well, the textbook has an example that shows if you start earlier, you can invest less money and earn a higher return than investing a larger amount later on. Let's look at how we can build this spreadsheet and understand the miracle of compound interest. We'll construct a simple spreadsheet to show the impact of the length of time that someone invests in their retirement, the impact of that on the savings. We're going to do a simplification of things. First, let's set up our first column is year. So while you'll be making contributions to your retirement plan every paycheck, that could be twice a month, for example, we'll actually just look at this as one annual contribution because we don't need a super accurate result to see the impact of compound interest. It'll make the spreadsheet much simpler to develop. Our next column will be the investment. We'll calculate the interest that we'll earn off of our investment, and we'll have the balance in the account. We can highlight these cells, center them, make them bold, put an underline underneath them. It's good practice to format your spreadsheets neatly. It gives people confidence in your work. For the year, we'll start numbering this 1, then 2. Let's highlight both of those years, and then we can drag down and Excel will automatically increment the years and fill in the rest of this for us. We might as well format these as centered, and if we select all 4 columns, we can format them at one time. Save ourselves a little work. Our investment, let's start with $6,000. We'll select that cell and we'll format it as a currency value. We don't need the accuracy down to the cent, so we can use this icon to format it as just $6,000. Also, we'll highlight this cell in yellow to identify it as an input cell. It's important to understand what are inputs into our spreadsheet model so that the user understands it. We could drag that 6,000 down, but let's use the formula equals that cell value, because we can then change this value to 10,000. And if we use a formula approach, all the following cells will take on that same value. If we just entered it as a number rather than a formula, then we'd have to change the entire column. We can drag this down. And again, we can go back to our 6,000 example, and everything in that column changes. To calculate the interest, we'll need to have an interest rate. So at the top, let's put the heading rate. Let's right center that and bold it. Let's put in our interest rate value. Let's use 8%. And if I enter the percent sign along with the number, then Excel will look at that as 0.08 when it does mathematical calculations, which is exactly what we want. Yet, for the user, they'll see it as 8%, which is more understandable. Let's center this and also highlight in yellow so that we see that's the other input to the problem. We'll assume that we're making the investment at the end of the year, so we'll earn no interest our first year, and our balance will just be equal to our original investment. In our second year, we'll earn interest on the original $6,000. So to calculate that, we'll enter the formula equals, we'll click on our balance, and then we're going to have to multiply that by the interest rate. So we'll enter the asterisk, then click on the rate cell. Now we're going to want to copy this formula down, and if we don't take care, we'll be incrementing that cell value. So let's look at that. If I don't do anything with that C1 reference, and I drag this formula down, we're going to get incorrect results because it's going to be referring to C6, C7. It's going to increment that cell, and we always want it to refer to cell C1. So let's undo that step. And let's start over again. To get it to work correctly, we're going to say equals the balance times, and then when we click on the cell with the rate, the F4 key in Windows or the Command T keys in an Apple computer will enter dollar signs with the cell reference C1, which means always refer to C1 no matter where I copy this formula. Now that we have that done, as I drag this down, I'll be getting 0 until I finish the balance column, but I'll notice that I'm always referring to cell C1. The formula for the balance is going to be equal to our previous balance, because we're adding to it, plus the investment that we made this year, plus the interest that we earned off of the previous year's investment. So that'll give us $12,480. We put in $12,000 and earned $480 in interest. Now we can take and drag this value down to year 30, and we'll see that in 30 years, we'll have $679,699. So getting close to $700,000. One thing we can notice is that the interest is small at the beginning, but it grows quite large because our balance is growing and we're earning interest on our interest. Again, the balance formula, we're taking our previous balance plus the interest This new balance includes 480 of interest, and we're going to earn 8% on that in this case. We can play around with this spreadsheet and say, well, what if we're earning 10%? What if we have a fairly aggressive investment? Notice that this gets us nearly to $1 million. What if we have a conservative investment, say at 4%? That only brings us to $336,000. So the interest rate and the earnings we make on a retirement investment is very critical. And we have to look at that balance of risk and return. Let's return to 8% interest. Let's return to 8% interest. And now to compare and understand the impact of 30 years of investment, let's create another table and assume that we waited 10 years from starting the job to start investing in our retirement. Let's take the first 20 years from this spreadsheet, right-click on these selected cells, select copy. Let's move over here and paste that. We don't have it quite in the right place, but that's okay. We can just drag it up. What we want is the end of the 20-year period for this investment option to be the same as the end of the 30-year period in the other option. If we started later, we might want to put more money in it. So in fact, if we put $9,000 in as our investment, we will have invested the same amount of money in total that we did with $6,000 over 30 years. Notice that this will only earn $411,000 versus the $679 with the 30-year investment. Again, if we look at and total our contribution, we can come up here and click on summation. We put in 180,000. Let's center all these. And let's drag this over and see that we earned almost $500,000 in interest in that investment. Do the same thing over here. We'll sum up our investment and confirm that we invested $180,000 over this period. But because we started later and the compound interest wasn't working as long for us, we only earned $231,000. So this simple spreadsheet illustrates the importance of starting a retirement investment early and getting the advantage of what's called the miracle of compound interest. The miracle of compound interest works against you if you're dealing with credit cards. Many people have too much money. Let's just go to the next thing. Credit cards have high interest rates, frequently 20% or more. Furthermore, credit cards frequently have low minimum payments, typically 3%, with a minimum of, say, $20 or $25. These low minimum payments allow you to spend a lot of money, never really advancing on paying off the debt. The textbook has an example that illustrates this. Let's look at how we do this with an Excel spreadsheet. To understand compound interest and the impact of compound interest on paying off a credit card when you're making the minimum payments, we'll take a little more granular look at this. We're going to look at a monthly set of data for 1 year. Let's start here in row 5 with a month. Next to it, we'll put our beginning balance. That's the balance when we get the credit card statement. The interest charge on that particular balance. The statement balance, when we get the credit card statement, it'll show what is owed, which is all the accumulated charges and the interest for that particular month. And finally, we'll have the minimum payment. Let's take all these headings, center them, make them bold, underline them. At the top, let's enter the interest rate let's start with 20%. Let's align that so that we can see it. And we'll put in a minimum rate. The minimum payment on a credit card is typically 3% of the balance. We can adjust that as well. We'll identify these as parameters of the problem, as input cells. We'll put in a couple months. Drag that down so that we're looking at 1 year. And let's make everything centered so that it looks good. We'll start off with a $10,000 balance, formatting that as currency. And in this case, we'll leave the cents. The interest charge is going to be equal the beginning balance times the interest rate. This is an annual interest rate. First, we'll use the F4 key or the Command T for a Mac to make it an absolute reference. And we'll need to divide by 12 so that we'll get the monthly interest charge. So $166.67. Our statement balance is going to be equal to the beginning balance plus the interest charge. Finally, the minimum payment is going to be equal to 3%. Use the F4 Command T to make that an absolute reference, times our statement balance. So $166.67 in interest charge, we need to pay $305. If we don't have any charges, we don't do anything else, the next month, our beginning balance is going to be our previous statement balance minus the minimum payment. So we see we went from $10,000 to $9,861.67. We took something off that, a little under $150. Now we can take the interest charge, the minimum payment, statement balance, copy those down, and take the second month's row and copy it all the way down to month 12. Let's put an underline and look at a couple different things. Let's look at how much interest we paid over this 1 year. Total of $1,854. That's a lot of money. You can buy a lot of nice things with $1,800. Let's total our minimum payments. So we paid $3,393, and $1,800 of that was interest. The principal reduction, in other words, how much we reduced our principal by, was our payments minus our interest. So only $1,500. So we paid $33.93, only $1,539 of that was paid down to our principal. It will take usually about 18 to 20 years to pay off a credit card at the minimum payment. A couple things you can do with a credit card is try to find a credit card with a lower interest rate. Sometimes you get a 0% rate for the first year. That means all your payments will go against the principal. If we dropped our interest rate to 13%, now we've knocked $2,000 off of the principal. And instead of paying the minimum payment, let's say we can make that $400. That additional payment above the minimum all goes to the principal. So if we copy that down, now we see we've reduced our bill quite a bit. We're down to $6,600. So just getting a better interest rate and making it a little bit bigger payment, in about 3 years that credit card will be paid off versus something close to 20 years if we're just making the minimum payment. When you're investing, there's always a relationship between risk and return. To get a higher potential return, there's usually risk involved. And the risk means that you may not earn the amount that you expected. In fact, you may lose money with a risky investment. So this is something that needs to be managed. If you have a very low risk investment, the earnings will really not get you to where you need to be at retirement. So the idea is to find the right level of risk to get the right level of return. Also, not all risks are created equal. For example, you might invest with a friend who's on an adventure to start gold mining in Alaska. You could make a very huge return, but there's a very large chance that your entire investment will be lost. What we'll talk about is the kind of risk and return where if you invest in equities and you invest in companies and you do this properly, there may be periods where your investment will lose value, but over the long run, over the kind of period that you should be talking about to invest for your retirement, the return will be substantial and will allow you to effectively save for your retirement. Warren Buffett, the Oracle of Omaha, who's done significantly well as an investor, has said that in his will, he's going to invest 90% in a low-cost S&P 500 index fund with 10% in government bonds. This is quite interesting because Warren Buffett has been known for building wealth for himself and investors in Berkshire Hathaway by picking and choosing winners and losers in the marketplace. But he himself points out that investing in an index fund like the S&P 500 index will do better than most investors, especially because they employ a high fee for managers. Let's look at the S&P 500 index. The S&P 500 index, which is covered in more detail in Chapter 14, is a capitalization-weighted index. Capitalization is the market value of the company. It's the number of shares times the price for that share. So larger companies have more shares at a higher market value than smaller companies. The S&P 500 index is an index composed of 500 large companies, not necessarily the largest at any point in time, as the companies in the index change over time, but it's an index composed of 500 large companies traded on U.S. stock exchanges, primarily the New York Stock Exchange and the NASDAQ. Those 500 companies make up 80% of the market capitalization of all publicly traded U.S. companies. So with 500 companies, that's 80% of the market value of all U.S. companies that are publicly traded. Again, there are numerous large companies that are not publicly traded. With the S&P 500 index, you are generally investing in America. The U.S. has gone through good times and bads, but over its history, it has proven to be an economic powerhouse, and in the long run, that's a pretty safe bet. The availability of low-cost S&P 500 index funds is a tremendous advantage for investors. Low cost because you're not paying a manager to manage those funds, and those management fees can be 1.5%. Index funds don't need that because all they have to do is mirror the S&P 500 index. Without index funds, an individual would have to have quite a bit of money to be able to invest in 500 large companies. So these index funds really provide a great advantage for the small investor. And as Warren Buffett points out, these funds are really hard to beat. Some people will beat them over some period of time, but in the long run, it's very difficult to do better than the S&P 500 index funds, especially when you consider that managed funds have an additional fee. If we look at the S&P 500 index performance, it has made money. In fact, if you started with an S&P 500 index fund prior to the Great Depression of the 1930s and carried it through till the 1950s, you would have made money over time. Just looking at since 2000, there have been some significant periods of market drops. And in fact, the coronavirus pandemic has caused a significant drop in the index from the end of 2019 to April 1, 2020. The S&P 500 index has lost a significant portion of its value. However, this is, like everything else, a short-term phenomenon. By short-term, we mean a number of years. The financial collapse in 2008 was something that was recovered, but it took a number of years to do that. So this is an important factor to consider. When you're investing for retirement, if you have 20 or 30 years to go until you retire, any drop in the S&P 500 index will be recovered by the time you retire. As you get closer to retirement, though, you're going to want to change your retirement so that you aren't subject to the risk or the volatility of the stock markets. One thing that should help investors feel more comfortable with the ups and downs of the stock market is the concept of dollar cost averaging. It's important to remember you only lose money in the stock market when you sell a stock for less than you paid for it. So you only lose money when you sell a stock or the company goes bankrupt. Companies do go bankrupt, even large companies go bankrupt, but it's fairly rare occurrence, especially when you're looking at stocks on the S&P 500 index. So really the only mistake you can make is selling when it's in a down period in the marketplace. And again, if you're saving for the long term for retirement and you're not too close to your retirement period, then you really have nothing to worry about when the market goes down. Sure, it's unfortunate to see that your retirement fund has less value on the market today, but if you're not taking it out today, it doesn't make a difference. Index funds reduce the risk from bankruptcy because you're investing in an index of 500 companies, and even if one or two go bankrupt, the bulk of them won't, and the bulk of them will earn very good returns for your retirement fund. When you invest in the long run, you reduce or even eliminating the risk from market volatility as long as you change your investment portfolio properly when you get close to retirement. The big advantage and the big key to dollar cost averaging is if you invest consistently, every paycheck you're investing in a retirement fund, it allows you to buy low. During these periods where the market is down, you're buying funds and buying your investments very cheaply. Typically, people who try to buy low and sell high, which is common wisdom, which isn't really valid, they never know when the bottom is and they never know when the high is, and it's very difficult to time the marketplace. Again, if you're investing for your retirement, what you want to do is consistently invest. In good times, you're buying funds that are still going to appreciate. But in the down times, you're buying low and going to get a good return on that particular part of your investment. In the textbook, there's an example of how dollar cost averaging works looking at the S&P 500 index. Let's go to a spreadsheet and see what the return has been for the S&P 500 index over the previous 20 years. We're going to start the spreadsheet with what's called the S&P 500 Total Return Index. The Total Return Index factors in dividend payments. Many stocks, especially for large, well-established, what are called blue chip companies, pay regular dividends to their shareholders. Because interest rates have been dropping over the last 20 years, dividends are becoming smaller and less frequent, especially with new high-tech startups. But dividends are still a significant portion of investing in a stock. S&P 500 index funds take those dividends and reinvest them in the index. So the S&P Total Return Index factors that in, so you get the return from dividends as well as growth in the share value or the stock value. From 1999 to 2019, there were a number of years in the early 2000s, 2008 as well, where the S&P 500 total index return actually reduced in value. So somebody's portfolio would be worth less because the value of the S&P 500 index was decreased. While that doesn't feel good when that happens, we'll see from this spreadsheet that investments in the S&P 500 index in those periods of time get big returns when the marketplace returns to its original value. Investments in those periods get very good returns because we're buying the S&P 500 index cheap. Let's add investment for a column, total investment, shares purchased. So for the index value, what will we be able to buy? Total shares owned at each point in time, and the investment value. We'll take these headings, we'll align them, make them bold, and underline them. Let's assume a $10,000 investment. We'll format this as currency, just dollars, and center it. And we'll use the equals formula so that we can change that when we need to. Center that. And we can highlight that investment cell the original investment in 1999, has a value that if we want to change that, let's say to 20,000, we'll change the entire investment pattern. Our total investment for the first year will just be 10,000. For the second year, we're going to take our previous year's investment and add the current investment, and we carry that down. So we'll have $210,000 of investment by 2019. Shares purchased will be equal to the money we invest that year divided by the total return index. We're showing a lot of decimal places. Let's just bring that down to 2 and align it. And we'll drag that down. One of the things we should notice immediately was we purchased nearly 5 shares in 1999, but in 2001, because the market was down, we actually purchased over 6 shares. We bought more shares of the index in this down year than we did in the previous up year. This is where dollar cost averaging comes into play. When we look at the shares purchased, the more shares we get for our 10,000, the more they'll be worth in the future when the index gets to be a significantly large value. For total shares, in 1999, we just take the shares purchased. For each subsequent year, we take the previous total and add the current year's purchase. We can drag this down and align it. Excel has a question about our formula, and we're just going to tell it to ignore that, what it thinks is an error. We align it here. Finally, the investment value, we take our total shares times return index, and that first year we'll get 10,000. Let's align it and copy it down. And we'll see that by 2019, our investment's worth $602,000. So we put in $210,000 total investment, and we've almost tripled our money. So even though it went down in certain periods, we're buying those shares cheap. In those down years, we're buying a lot of shares compared to the period prior. And when the market returns in value, which it does eventually, we're getting a lot of value for those shares purchased. We can figure out what kind of return on investment we got from the S&P 500 index by copying a couple of rows over into some adjacent cells. We'll drop this index out, delete that column, and up here, I'm going to type comparable rate. In other words, what's the comparable interest rate to our investment in the S&P 500 index? Let's just put 5% to start with, just a dummy value, and we'll highlight that. Next, we'll put a heading for return and our balance. And again, just like the S&P 500 index, we're going to have a 0 return that first year. We're going to assume, as we did with the S&P 500 index, that we were making that investment at the end of the first year for simplicity. So in the first year, our balance is our investment plus the return, which is 0. In the second year, our return is going to be equal to the interest rate, again with the F4 or Command T key, times our previous balance. Our total balance is going to be our previous balance plus our investment plus the return on our previous balance. We align these, align this. We can now copy this down. And so we'll see that at 5%, our balance would only be 357,000. The S&P 500 index gave us 602,000, so the return is higher than 5%. We can see what happens at 6%. It's now almost 400,000. 7%, we can play a trial and error game to see what the comparable return would be on our S&P 500 index. The easiest way to do this, though, is to use a feature of Excel called GoalSeek. Under Data, there's a series of tools called What If Analysis. GoalSeek is a nice, simple, but powerful tool that says, let's try to get a result in the Excel spreadsheet to equal a certain value by changing one of our cells. So with this GoalSeek tool, we can say, let's get this cell to equal what we have over from the S&P 500 investment, 602, 601, by making changes to the interest rate cell here. So rather than doing trial and error, we're going to call on the power of Excel, accept its results, and we'll see that we get the same return when this, let's add a little bit of precision here, is 9.5%. So we'll look at our investment from 1999 to 2019, when there were actually 3 downturns in the S&P 500 index, because of dollar cost averaging, earned us 9.5% return. So for investment purposes, the S&P 500 index has a very good return, a fair amount of safety in the long run because of dollar cost averaging. And if one is 5 to 10 years from retirement, a good investment. As we mentioned, dollar cost averaging works very well for investing in the long term. But as you get closer to retirement, you're not going to want to keep all of your funds in equities. The volatility and the risk is a problem. Imagine if you were retiring in 2020 and you had to start pulling out of your retirement funds with the marketplace drop that occurred from the coronavirus pandemic. This would not be a good situation. So as you get towards your retirement, you want to move your funds away from equities and slowly get into more stable, less risky, but lower return investment funds to preserve the wealth that you've built. You can do this manually as you manage your funds with an advisor, but there are also funds that do this automatically. For example, BlackRock is one investment company that has a product called LifePath Dynamic 2055 Fund. So this would be a fund that's designed for someone who's going to retire in 2055. And what does it do? The key thing that this fund does is it adjusts automatically to become more conservative as you near retirement. So this is a great option because you don't have to try to make those decisions yourself. This fund will manage the investments to get a good return early on and become more risk averse to preserve your wealth as you get near your retirement age of 2055.